Sports stadiums often promise huge economic benefits, new jobs, and increased tourism for their host cities. They are symbols of civic pride and potential prosperity. But have you ever wondered why measuring these economic impacts is so often a subject of intense debate and conflicting reports? Stadium economic impact analysis is exceptionally difficult primarily due to fundamental methodological challenges, the complexity of isolating true new economic activity, and the frequent influence of political motivations. It is rarely as straightforward as proponents suggest. The core difficulty lies in accurately accounting for what economists call the substitution effect and leakage. The substitution effect occurs when money spent at a new stadium would have simply been spent elsewhere locally on other entertainment or goods. It is not new money, but rather a reallocation. Leakage happens when a significant portion of stadium revenue, such as ticket sales, luxury suite income, or merchandising profits, leaves the local economy, often going to out-of-state owners, players, or league offices. Furthermore, such analyses often fail to consider the opportunity cost, which is the benefit that could have been gained from using the public funds or land for an alternative project, like schools or infrastructure. A robust analysis must establish a counterfactual scenario, carefully comparing the economic situation with the stadium to what it would have been without it. Without this baseline, it is nearly impossible to determine genuine incremental economic gains. When evaluating economic impact claims, it is crucial to look beyond gross numbers and demand a net impact assessment. This means subtracting the economic activity that is merely shifted from other local businesses or that leaves the local economy. Always question if the analysis accounts for existing local spending and whether it clearly defines new money versus reallocated money. Also, scrutinize the assumptions used, particularly regarding multiplier effects, which often inflate estimates by overstating how many times a dollar cycles through the local economy. A reliable study will be transparent about these assumptions and use conservative figures. An insider detail to remember is the difference between direct, indirect, and induced impacts. Direct impact is the initial spending, like ticket sales and stadium construction wages. Indirect impact is the spending by businesses supplying goods and services to the stadium or its visitors. Induced impact is the spending by people whose incomes increased due to direct and indirect impacts, like stadium employees spending their wages. Many studies overemphasize the induced impact, which is the hardest to measure and often the most inflated. Understanding these inherent complexities in stadium economic impact analysis empowers you to critically assess claims and contribute to more informed public dialogue. By recognizing the potential for overestimation, especially regarding substitution effects, leakage, opportunity costs, and inflated multipliers, you can better discern the true economic implications of these large-scale projects, fostering sounder policy decisions for communities.